And back to the local market now to see how it reacted to the US slump overnight. Earlier I spoke to Ken Howard from RBS Morgans in Brisbane. Ken Howard, what's your assessment of yet another volatile day?
Yeah, certainly a very volatile day. It started down a couple of percent, no doubt driven by nervous investors who were potentially facing margin lending, margin calls and the like. So they were obviously very quick to sell. But as the day rolled on, some of the rumours that were washing around the American market and the European markets about downgrades for the French sovereign seemed to be dispelled, and our market started to focus a bit more on fundamentals and staged a pretty good recovery from about lunchtime onwards, which was nice to see.
And across the sectors there were sort of pockets of promise and then pressure on other sectors.
Yeah, actually some of the sectors that performed the best were the banks, the non-discretionary such as Woolworths, Wesfarmers, Coca-Cola, the utilities, the infrastructure, all of the defensive stocks seemed to do well. Gold did well, which was no surprise, but BHP and Rio, which is quite unusual, were actually amongst some of the worst performing stocks on the market today.
So what have you been telling your clients?
Look, certainly my strategy over the last week has been to look for bargains amongst the stocks that are in that non-discretionary space. Look for the stocks that are providing those basic everyday utility type products that people need, whether it's the food distribution, whether it's Telstra, whether it's the big banks. Look for the businesses with the strong balance sheets, the good yields, and that are providing that basic everyday product that people need. Those sectors held up best during the GFC. Even the commodity stocks got a pretty rough deal during the GFC, so trying to stay with the defensive right now.
And what's the feedback from some of your clients at the moment?
Look, it's a bit mixed. Obviously, with all the volatility, it would be nice for everybody to be brave, but really, it's very natural for people to look at this volatility, and probably 2/3 of clients actually want to sit on their hands. The opportunity to sell out and take profits probably ended about a week or so ago, so a lot of cautious investors out there, but certainly there are some who are seeing this as a great buying opportunity. We're seeing prices that we really haven't seen for 2 years. Some of these stocks trading close to GFC type multiples, so some good buying in the market if you've got the nerve to do it.
Now, one stock that took quite a hit at the beginning of the day was Macquarie Group. How did it perform through the rest of the day?
Yeah, look, Macquarie strengthened through the day but still finished in negative territory. As I indicated, the negative sentiment for Europe and the United States last night was around French sovereign debt, but it was also around some of the big French banks. And we saw Societe Generale down the best part of 20% at one stage during last night's trading. So Macquarie Bank is very much being blown in the wind in the same direction as the global merchant banks and the other big banks. So it represents extremely attractive value at the current prices, but it's also at the sharp end as far as the negative sentiment is concerned.
Blowing in the wind, you say. I'm sure there's more wind to blow, but how do you feel we'll end up at the end of this week?
I'd really like to think that the key sentiment issue for the global market was around the Italian bond rates and the Spanish bond rates, and the European Central Bank intervened in those markets on Monday and Tuesday night and was able to bring those bond rates down from about 6.5% down to 5%. The real risk there was that we were seeing the early stages of contagion where credit markets might actually lock out the Italian and Spanish governments. Now that's been put to rest. The European Central Bank can effectively buy an unlimited supply of any European sovereign. They print the euro, so they have that capacity. So any desire by some to short Spanish or Italian bonds surely has come to an end. And if this really has been a sentiment-driven collapse in the market, well, it can just as quickly turn around and maybe see our market back, maybe not to 4,500, but certainly heading back in that direction as the week draws to a close.
I hope you're right. Ken Howard, thank you very much for joining us today.
Thank you to you.